Good afternoon, everybody. I'm Professor Mark Ergani, Associate Professor in the Theology Department and Director of the Center for Ethics and Society here at Saint Anselm College. And I'm very excited today to welcome you to our presentation, AI and the Future of Investment in a Deglobalized World with Dr. Stephan Unger. The topic for today's event really dovetails beautifully with two other events that the Center for Ethics and Society has recently hosted. There was the State of AI in the Granite State, which was hosted here in December with experts from McLean Middleton, as well as members from our community in journalism, in wealth management, as well as in technology, speaking about this rising tide of AI and its critical importance as we start to look into the middle of the 21st century. And we also, in February in fact, we hosted Dr. Danny Roderick, who spoke on shared prosperity in a fractured world, in thinking about the ways in which the globalization, now all of a sudden we're starting to see challenges that are moving us towards perhaps changes in relationships and how that affects our understanding of how we live in our local, in our state, national, and global communities and some of the challenges there. Today, when we look at this presentation from Dr. Unger, he will offer us a forward-looking framework to understand where capital is likely to flow in a world defined by both technological acceleration and economic fragmentation. And our speaker today is quite accomplished. He's a professor of finance here at Saint Anselm College with extensive experience both in academia and in the financial sector. He's worked as a stockbroker, corporate FX fixed income structuring specialist at an investment bank in London, Milan, and Munich, and he was director of an algorithmic FX trading firm. In academia, Dr. Unger has held positions at Vienna University of Economics and Business and at the University of Vienna in Austria with a focus on finance, monetary policy, and macroeconomics. As a longstanding member of the program committee and senior advisor of the World Energy Council in London and Vienna, he oversees the agenda of the World Energy Council Austria and coordinates the Young Energy Professionals program in Austria. He also holds a diploma in jazz piano and an MA in ancient philosophy from the University of Athens in Greece. He's quite a Renaissance man, and we're very welcome to have him share with us today. Dr. Unger?
Thanks, Mark, for the nice words, introduction. Welcome, everybody. So happy to have everybody here to this really important topic. Very timely, hot topic, which will affect everybody of us. Where to start? This topic would actually need a whole week of presentations of various topics related even just to investments. I chose a topic more focused on the current geopolitical environment, the development around the world, especially also with respect to the development in the AI sector. So, as you can imagine, I try not to go too much into detail regarding the current AI development, because if I did this last week, then today this presentation would already be out of date, because things are progressing so fast. When 2 days ago, OpenAI said that they won't support Sora anymore, so it's really progressing super quick, everything in AI. I want to focus more on the general trends over, I would say, the next decade plus. And with this respect, I'm investigating the future of investment, not only with respect to AI, but what we face is current development in the world, which is characterized by global fragmentation. So you see move towards deglobalization, and this is actually a topic which was the driving factor of the last 3 election cycles. As you remember, we had always the discussions between Democrats and Republicans arguing forth and back, globalization is the evil, it costs job. On the other hand, you have the counter argument, deglobalization costs now jobs, and where does AI play into this? So this is why this is super tied together, these two topics, as I will show to you. So yeah, it's based on a paper I'm just writing. So these are preliminary results, of course, not published yet, but soon, hopefully. And so let's get started with the overview of what my topic will be about. Let's see how long it will take in general, maybe half an hour, 40 minutes in total. Then we are open to Q&A and active discussion. So this will, as you will see, this whole discussion can go different routes. So we can have a discussion on impact on job market, on the economy, on money, on investment, the whole future of education. So there are different routes we can then discuss. For now, we'll focus just on investment, since investments determine pretty much what will happen in the future, right? Where the money goes, that determines what will be built, what programs will be instituted, and all these things. So I structured my talk into 3 sections. The first one is dealing with the general effect of deglobalization on unemployment. So did a little research on that part, and this will reveal you very interesting insights where you will see that we'll see different effects deglobalization has on the economy. The second part will be the impact of AI on unemployment and inflation. It's closely linked to each other, and how AI reshapes work. And the third point, the core of this talk, of course, the investment implications associated with that. So with this respect, we'll present an allocation framework and actionable conclusions, what investors should do, will do, might do in the future. So these are the 3 points. So let's start with the first part, deglobalization and unemployment. What I did was I was analyzing 179 countries over 27 years and figuring out what effect does deglobalization have on unemployment. For this purpose, I used a globalization index, a KOF index from ETH Zurich, which measures how globalized the country is. We'll show you then the ingredients of how this index is composed. It's interesting to see. But it tracks pretty well how globalized the country is and which factors contribute to that. So, and what I was analyzing was the effect of the level of globalization on the unemployment levels in these countries over 27 years, 179 countries. So it's a pretty big sample size and representative. What would you say if I tell you the whole discussion about deglobalization, before we jump there, deglobalization raises unemployment, or deglobalization doesn't? What would you say? What would you think? This was the whole discussion about the last election cycles, right? So the Democrats, Republicans, both were arguing forth and back. What if I tell you that both were wrong and right at the same time? The interesting part is what empirical data shows is both is true and wrong, in the kind of way that it depends on the level of globalization a country actually is in. We have to distinguish between countries that are already highly globalized or countries that are not yet highly globalized. The effect, what we see is that globalization itself, the dynamics of globalization has on these countries, which are in a certain state, depends on these levels, what it has on unemployment. For highly globalized countries, it can be found that deglobalization actually raises unemployment. So that's true in that case, that you can argue, good, for countries that are highly globalized, and you deglobalize now, they are so highly dependent, we see this with just-in-time supply chains and so on. Deglobalization ripples through these economies and causes actually unemployment. So it's a matter of fact. So it's a disruption of specialized value chains actually that creates a coordination failure in these economies. On the other hand, how about countries that are less globalized? In that case, deglobalization reduces unemployment. And that's the interesting fact. So if somebody argues globalization is bad, it depends on which country he's talking about and which level the country is in. Is the country highly globalized or not? So in that case, why does this actually reduce unemployment? Because domestic production is shielded from foreign competition, what we call protectionism. So if you put these 2 scenarios together in one graph, what you get is a bar chart, which has on the lower axis the globalization level. So we start from on the very left with a very low level of globalization of a country up to highly globalized. And on the other axis, we have where we measure unemployment, respectively inflation. In blue, you have the level of unemployment. In red, the level of inflation. And as you can see, that depending on the level of globalization, first we focus on unemployment. So unemployment. The blue bars show that at low levels of unemployment, at low levels of globalization, we have low levels of unemployment. With increasing levels of globalization, unemployment grows up to a certain friction peak. That's where we have a globalization level of roughly 50%. That's a friction peak. After that, we see a decline in unemployment with increasing level of globalization. So it's very interesting to see. On the other hand, what we can see is that for inflation, we have a downward trend, which is the selling part, or was the selling part of globalization, that products get simply cheaper because they can be produced where products simply can be produced at cheaper labor cost, cheaper resources, and so on, and are then simply shipped, right? So far, everything was mostly manufactured in China and then shipped to the US and Europe, for example. So as we can see, the more globalized the country is, the lower level of inflation this country experiences. This has now nothing to do yet, doesn't take into account anything with the monetary system, but we talk about fiat money and the creation of inflation on that side, and from the monetary perspective. That's just purely from a cost perspective, from a production level. So that's interesting to see. The first insight, or what can be gained from that, is that the level of globalization is insignificant, meaning the globalization level has no systematic long-run effect on unemployment. So it's interesting to see in the long run, what matters is more the structure of the economy, meaning the GDP per capita, for example. So how wealthy an economy is, that determines more the level of structural unemployment. So the institutions matter more than the level of globalization itself. What we see in the long term is that markets adjust. They self-correct themselves. For example, that labor reallocates across sectors during the process of globalization. Malinvestments gradually unwind, and the economy absorbs deglobalization without persistent unemployment rise. So the implication from that is that in the short run, we see disruptions if it comes to globalization or deglobalization, works both ways. But in the long run, outcomes are governed by institutional quality and wealth, not by the degree of openness itself. To see where we are on this curve roughly, so I know there's a lot of stuff on this slide now, but to focus just on the graph in the middle, that's this KOF index I was talking about, the globalization index, which tracks over the last 50 years the levels of globalization for all the countries. We see the ingredients of the KOF index, what it measures, right? We have investment flows, policies, and political globalization levels, and the factors what are accounted for, what determines this index, like tariff rates and migration, cultural proximity, how many McDonald's branches are in these countries, and so on. So this all plays into that determination of that index. You can see the highest level of globalization is actually in Switzerland, which has a high level of almost more than 90, followed by US and Germany between 75 to 80, then China and Russia from 50 to 65, and India about 50, rising. We can see Switzerland is the highest here in blue, followed here by Germany and the US. Then we have US here in purple, then Russia, and we can already see this downward trend within the last 1-2 years. So this is, of course, still data from I think 24, 25. So even 1 year or 2 years lagging behind. So this actually went down even more in the meantime. So we can here actually see this trend of deglobalization, because the index simply decreases. Okay, so far so good. So we know now the effect of that we have to distinguish in which regime we are in a country. If we are highly globalized or in a low globalized country, and depending on that, we will have different effects what the process of globalization has on unemployment. Good. How does this now track actually and build the bridge to AI? The role of AI is that AI doesn't just move countries along the globalization axis, but it reshapes the axis itself. What this means is the following. We have to distinguish here, first of all, about this peak we saw. We have two scenarios. The level without AI and the level with AI. Or the scenario without AI and with AI. So far we were on the left side, in the scenario without AI, very human-centered, human-focused. And we saw that during the process of globalization, humans usually retrain slowly compared to computers, obviously. Capital is very industry-specific, and the peak friction is unavoidable. So that means when we move from very not globalized countries to highly globalized countries, so from left to right, we see ultimately some level of high unemployment peak. That's usually also where populism explodes at these levels, until it comes to actual integration of the benefits of globalization. So the friction peak exists because humans are slow to retrain. Factories can't become server farms overnight. So that's where AI jumps in now, because AI dissolves both constraints. So in the world with AI, that's where we are going towards, trending towards. AI retrains in seconds, obviously. We know that capital, and therefore software, deploys anywhere. And structural friction will approach, because of that, almost zero. So what we can see and what we can, with this respect, expect is that countries which are not yet so globalized, but are integrating AI in their countries, like Saudi Arabia and all these Middle Eastern countries. Good, bad topic now, but you know what I mean. South America, for example, server farms and stuff. So which want to globalize or become more open, regardless of global trends right now, will benefit from AI in the sense that they won't undergo this huge unemployment peak or friction, simply because AI flattens this. However, so that's the transformation from barely globalized to highly globalized. However, when we come to, this needs a little bit of explanation, this chart, to the long run, systematic effect of AI, we see the following effect. Let's start with the dotted line. The dotted line is nothing else than the bar chart we just saw in a human-centered world. So we start at low level of globalization, then go up with higher unemployment, and the more globalization levels we face, that's what the data simply shows across 27 years, the more globalized the country is, unemployment goes down, levels down at some point. From a level of 70 onwards, we regard a country as highly globalized. Inflation, the red dotted line, as we can see, is downward sloping, and with respect to increasing globalization, inflation and price levels go down in general over time. Okay, what does AI now? AI comes now in the game, and let's focus first on the inflation level. What it does here is that obviously for any level of globalization, AI deployment lowers the costs. So everything will get cheaper. It's highly deflationary. Of course, we know everything is automized and produced much quicker at scale, so everything will become a lot cheaper, all the products. Up to a certain point, where in highly globalized countries, that also means that AI deployment will be highly effective, and see this effect on labor then, up to a point in the future where things will become so cheap that the price levels simply crash to zero. Everything will be almost for free. Yeah? Depending on the cost of energy, of course, what it costs for AI to run the data centers, for the robots, and to mine rare earth minerals and all these things. These are fixed costs. But in general, across the product lines, the costs will crash down to zero. Not everything will be almost for free that can be produced by machines and robots. The effect on unemployment, that's an interesting one. We see that from the original humanized world, the level of unemployment will, as we saw from this slide, will flatten down in the transitional phase from low globalization to high globalization. So this curve will shift down up to a level of globalization level of 70 plus. So up to a level of for countries which are highly globalized. And what's happening there is a tragic effect, but a rationally understandable effect, that unemployment will skyrocket, of course. So at some point, at high level of globalization, highly globalized countries, we will expect unemployment to increase simply. So it's just a question of time when this will happen. Of course, there are discussions. There will be new jobs. That's true. All right, because 10 years ago, nobody would have known what an influencer is, right, as a job. And nowadays, these are the two new types of jobs. In 10 years, in 20 years, there will be jobs which we can't even think yet of what this will be in the future. Nevertheless, this will be, I have no idea, maybe 5%, 10, 20, should it be 30% new types of jobs, but simply the rest, 70, 80, 90% will be replaced because it's not needed anymore. It can be more efficiently done by computers, robots, whatever. For now, it's just a discussion that white-collar jobs will be replaced, right? The AI CEOs say 50% of white-collar jobs will be replaced in the near future. At some point, blue-collar jobs as well, when robots will be deployable and all these things. So that's the scenario we would face in this case. Yeah. Okay. So we have here a third effect with three different scenarios where we could see the development towards, and also where the policies and the future political discussions will go. On the one hand, we will have movements that will try to reach G0, meaning protectionism. Very brand new, actual, you heard it yesterday, Bernie Sanders and AOC introduced a bill for actually imposing a pause on building new data centers. That's exactly this move. Yeah? You're witnessing it live. Yeah? So a moratorium, that's how they call it. Yeah? So to stop simply all AI due to different reasons, not only the effect on labor, but also to wait to understand what AI, how we can actually effectively regulate it. It's an own discussion if it can even be regulated. Yeah? Okay, so in that case, protectionism, countries deliberately disintegrate to protect human labor. Yeah? So it's not economic efficient, it's not economically efficient, but it's about social preservation. Yeah? Human-only zones or robot taxes artificially recreate this shield of G0. Yeah? On the other hand, we will have countries around this G50 trap. Yeah? So as long as there's humanized labor existing, we will face and have there, of course, a lot of unemployment going on. So this is stuck at the maximum friction. without the old wage shield. This demand for deglobalization is a rational response for the maximum structural pain, not ignorance. And on the other hand, the extreme case would be a G100 level, so a fully globalized country, totally deployed AI, everything running on automated basis, robots driving, self-driving cars, everything automated. In that case, AI makes the globe hyper-efficient. But if human wages collapse, that creates now a paradox. If human wages collapse, who buys actually the output? So the consumer base simply disappears, and the efficiency without consumers is nothing else than economic suicide. So in that case, we will face a problem, because in that case, markets simply break down. That's where the discussion about UBI, Universal Basic Income, kicks in. And I don't know if I should go down that route now, but let's focus on the core dilemma first. The core dilemma is that future populism won't be about trade. It's about moving goods, like what's going on now, but it will be about intelligence and moving data. So it will be about the divide between those who want to integrate with the global AI grid and those who want to shield human labor from it. This will be determining the future policy discussions. Coming to investment. What are the implications for investment and where the global capital flow will go actually, and how AI and globalization regimes reshapes what works, what fails, and what you must own actually in the future. Let's focus first on the investment profile. Let's look at corporate yields and systemic risk, the relationship of each other. Depending on level of globalization, we will see or can expect that, of course, the yield, so the in green, so the money firms make, depending on the integration of AI, will obviously explode, right? So up to a level where they will become monopolists of certain products, for example, and they earn a lot of money. We see that move now already. For certain products, like when Anthropic released a new model, when was this? 1 month, 2 months ago, and Microsoft crashed on 10% in one day, and other companies too, because they will be replaced and can simply by AI. And who makes the money? Then, of course, the AI models, the AI firms. But obviously, what comes along with that is the yellow line as systemic risk, of course. Everything will be concentrated in a few, with few players who are behaving like monopolists or oligarchic community of, we see already the main AI models, the players who OpenAI, Anthropic, Google, and so on with their models, who try to gain more market share. So what we see is, or what we can expect is that for highly integrated and highly globalized countries which deploy AI a lot, that systemic risk will obviously explode as well. So in the green area, that's the left area, the G smaller than 70, the pre-AI zone, corporate yield and systemic risk grow together slowly, and traditional investing still works here. So risk is still cyclical and manageable, simply. For G70 level, so at this threshold of where a country becomes highly globalized and already deploys AI a lot, so that's a threshold where AI crosses the critical mass. The two curves begin to diverge sharply. So at the beginning we have low systematic risk, high yields, but then everything to the right of it, we are in the highly globalized zone where AI adoption is highest. Yields explodes, but so does systemic risk. So the gap between them is the systemic risk explosion. So high returns exist, but they carry civilizational fragility, actually. This brings us to the scenario where more and more countries will enter, actually. So in the level of highly globalized countries in the sense of AI adoption, simply because AI deployment reinforces globalization again. Yeah, so again, it's a different type of globalization we will see then. It's not this moving goods and shielding. It's a different framework, as we saw, with respect to protecting human labor, and it's about data that's being transmitted through different countries. So for highly globalized countries with high AI adoption rates, we can expect the death of human capital as an asset class. So the return on investment on, for example, that will concern especially future generations, college students and so on, in the return on investment on degrees and certification crashes in that scenario. So capital flees the labor-dependent sectors like services, law, middle management, and it all concentrates in compute and energy. Number two is a real estate valuation trap. Because if you think about that, if local wages collapse, so we saw this with the red cliff, local populations can't support high rents anymore, obviously. Yeah? So properties become safety deposit boxes for global wealth or face simply correction. So it will highly depend on is an area still inhabitable in the sense of that people can afford to live there if there are no wages anymore, right? So again, UBI discussion, yeah? Can maybe in the Q&A session then discuss this topic. Number three, equity versus labor divergence. The labor share of income drops in that case, yeah? And capital share, so corporate profit skyrockets as costs collapse, we saw that. And success in that case is defined by owning the machines, not operating them. And we will see a rise of sovereign shield investing. What does this mean? So governments obviously will react, it's a discussion going on already, by shielding sectors from AI. Yeah? So strategic positions in nationalized industries, for example, defense or local energy infrastructure, critical energy infrastructure, for example, and protected zones become the safe harbor. Yeah? Okay, so what this translates into, yeah? How risk itself changes from a G50, so a pivot zone, to the maturity zone of highly globalized countries. The risk type from cyclical volatility or recessions will turn into structural obsolescence. The question, will the market go down this year, will actually become to, does this asset have a reason actually to even exist? Asset models. So while you diversify now across sectors, it will all be about nodes. Yeah? So everything will be concentrated in nodes and compute and energy. Yeah? The safe harbor for now, as we know, are bonds, defensives, and real estates. This will shift into physical scarcity. So everything that has to do with land, minerals, and energy. With respect to human capital, which is still valuable, not yet replaced, this will be rapidly depreciating and will be a race to zero in the future. Yeah. So finally, you got me coming to the UBI question. What's a better thought about this? What a better approach than universal basic income, so the government handouts to everybody when nobody has a job anymore, would be, because that would create nothing else. That's what I wrote down at the bottom here. UBE, coming to that, that's universal basic equity, would be a potential solution to that. Why? First of all, if everybody gets UBI, universal basic income, you're depending on the government. You're restricted by whatever the government decides how much you get. You don't get more. Everybody gets the same, or depending on whatever the government requires you to do for them or have. So it's not ideal at all. What's better, and that's kind of borrowed this concept from the Austrian economists, is the universal basic equity approach. So in that case, everybody owns a certain share of a node, or tokens, or whatever you call it, and you are free, depending on from which node or energy model, AI model, or which energy node you own tokens, you're free to trade them depending on their value. The problem with UBI is once you destroy the basis for the consumer to consume, you destroy the price level. So there's no price anymore because there's no signal for prices, right? Because right now it's a question of supply and demand, how a price is created. But if everything can be produced at zero cost and nobody has money to buy it, there's not really a price. I mean, the government would need to determine the price level, and based on that price level, who says that this actually reflects the actual level of scarcity, right? Because prices always reflect the level of scarcity. And in that case, you actually end up in AI becoming a socialist central planner by accident, because AI will produce stuff regardless of if there is need or not. So this is a real danger, and that's why universal basic equity would be actually a solution, because in that case, you would again reintroduce a certain scarcity or in terms of buying and selling, so a market in AI models. So in that case, you would, instead of realizing this red self-destruction line of AI, so in terms of systemic profitability, with a UBE path, then you would preserve the market actually. Yeah, so that's the idea. Yeah, so I wrote here the problem without UBE. If wages go to zero, there are no buyers. No buyers means no prices. No prices, AI has no signal what to produce. And what you would end up would be rationalized chaos or digital feudalism. So in case of UBE, citizens would own tradable equity strips in AI nodes, not wages, but dividends actually. So this preserves the price signals, that's the Austrian logic actually, and keeps the market alive even when we are at the G100 level. Yeah, so in terms of potential future investment opportunities, I've made up this matrix here. So we have here on the bottom, low globalization, on the top, high globalization, to the left, low AI adoption, to the right, high AI adoption. So with respect to low globalization levels, we have and low AI adoption rates, so think of emerging countries, emerging markets, we have a first mover advantage. So they are not yet highly globalized, and they have almost no AI deployed yet, so there is the highest alpha opportunity, obviously. So there's an information edge, and yeah, so you can make money there easily. Yeah? That's not the case if it's already highly globalized country, but still low AI adoption rate. So in that case, alpha is near zero, so you can't really outpace the market because everything is priced in already, and the cost pressure is maximal. So only survivors are if you trade at scale, so quantitatively or passively with just go with the flow with the market, and whatever the market develops, you participate in. On the other hand, if you have high adoption rates in AI in a highly globalized country, so only disruptive incumbents would actually yield some profit. So traditional managers are under existential threat, and there's just a short window before displacement. And for low globalization levels but high adoption rates, there's a latent value, but it's a window which is closing. So they are building AI obviously very quickly, and the capability with respect to that, and yeah, they exit pretty soon probably. Okay, almost done. 2 more slides. Where investors must move now. Yeah? Actually, the trend will go towards, first of all, structural quality over globalization level. And AI forces investors towards assets where human judgment prevails. So we see the very highly AI adopted sectors like public large cap equities, for example, they will be highly saturated because everybody will deploy AI. Think of Walmart and everything, Amazon already talking about replacing human labor with robots, and sending packages with drones and stuff like that. So this will be highly saturated from an AI perspective. For them, of course, they will make a lot of money, but this will already be reflected in the stock price, for example. So investing into these companies kind of risky, rather the opposite, because if that's the case, then it's already priced in the stock price. So this would be rather something to exit. On the other hand, we have everything that's investment grade credit in general. They are also very heavily AI adopted already. So they are, in that case, also it's systematically of just holding passive positions, but rather exiting it. How about high yield or leveraged loans? It's AI moderate with selective, being very selective here. The more and more, as you see, we go downwards, the more human-centered and human judgment plays a role. So if we enter the level of private credit and private equity, we'll become more and more human dominant. So in the future, this is more where investors will overweight their positions, down to even, and then real estates and infrastructure, of course. Yeah. So their AI will be just a tool, because until they even start building and living in robots, living then in buildings, whatever, who knows what the future brings. But in general, over the next decade or so, this would be a structural overweight in any portfolio. Okay. So before coming to the conclusion, what are the actionable investment conclusions? First of all, don't select firms or managers just on AI capability. Select on the structural edge. So AI is just a temporary amplifier. In the long run, alpha is governed by asset complexity, institutional quality. So just as GDP per capita dominates the long run unemployment. Second, overweight informationally thin markets where AI is arriving. So less globalized, less informationally integrated markets offer the highest AI alpha opportunity. Marginal value of AI tools is greatest where the baseline data is the weakest. How about firms that are at the frictional peak? We talked about that. These need to be underweight. Traditional active managers in liquid public markets are about this G50. So you don't know, some are already AI adapted, some not. So there you have a maximum dispersion. So in that case, just avoid them unless you can identify which side on this hump they are actually on. What's important is that you have to monitor integrators versus insulators in emerging markets. So the key emerging question is here, are AI tools accelerating integration? So buy them before they actually reach this hump, or entrench domestic insulation. And last, position simply for regulatory friction, not fundamental change, such as if we come to the question when it comes to ownership redistribution, infrastructure nationalization, and international governance frameworks. This changes obviously the whole game plan. If until that is reached, you can position towards regulatory friction, meaning since AI labor displacement will trigger policy responses like robot taxes, for example, mandates and restrictions, as with tariffs, they won't alter the long run outcomes. So in that case, you invest simply in AI market beta. So you invest in the market, especially in segments which consist of these AI firms, and just ride the wave. You invest into political protected areas, sectors, like defense, for example. Then in sectors where you see that there's an integration catch-up, and where there's still a judgment premium. And very important is that you reallocate dynamically over time, because this obviously doesn't stay forever like this, and there will be frictions coming up in time. So to conclude, the level of AI integration, like the level of globalization, only matters at the margins and in the short run. Over time, the structural quality, so of institutions, of assets, of judgment, is